In 1950, if you worked 40 hours a week at a factory job, you could buy a house in 7 years. In 1980, it took 10 years. Today, working that same 40 hours, it takes 32 years. And that's assuming housing prices don't rise faster than your savings, which they will. A 25-year-old right now, following every piece of boomer financial advice, saving 10% of their paycheck, avoiding the lattes, still mathematically cannot catch up to asset appreciation. The finish line is moving faster than they can run. And here's the kicker. The government looks at this situation and says the economy is booming. GDP up, unemployment low, everything's great. But when you open your bank account, when you price out a starter home, when you stand in the grocery store checkout line, the numbers say you're lying to yourself about being poor. So here's what I'm going to explain. There's a structural split in the economy that's been widening for 40 years. On one side, you have the economy of income, where you trade your time for money. On the other, you have the economy of assets, where money makes money while you sleep. And the gap between these two economies has become a chasm. I'm going to show you exactly how the measurement systems are rigged, why your raises don't matter, and why an entire generation has rationally decided to stop trying. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Think of the economy as a carnival game. You know the one. You throw balls at milk bottles, knock them down, win a prize. Simple. For decades, this game worked. You show up, you throw your balls, you knock down bottles, you win. The relationship between effort and reward was direct. But then, around 1973, the carnival owner made a change. He kept the same milk bottles on display at the front of the booth. Same prizes hanging overhead. But he started moving the entire back wall farther away every single night. Just a few inches at first, then a foot, then several feet. Now here's the thing. The carnival owner still measures your throwing accuracy based on the old distance. He still tells you you're getting better at the game, your stats look great, but you're not winning any prizes anymore. And when you complain, he shows you a chart proving that your throwing technique has improved by 40%. He's not technically lying, you are throwing better. But the game itself has been fundamentally restructured. That carnival game is the labor market, and the back wall is the cost of asset ownership. Let's talk about how they measure the game. For decades, we used something called the Consumer Price Index to track inflation. It was simple. Take a fixed basket of goods. Measure how much that exact basket costs this year versus last year. That's your inflation rate. It answered a clear question. How much does it cost to maintain the same standard of living? But in 1996, something called the Boskin Commission decided this method was overstating inflation. Their argument was that when prices go up, smart consumers don't just keep buying the expensive stuff. They adapt. They switch to cheaper alternatives. So the government shifted from measuring the cost of goods to measuring the cost of living. Sounds reasonable, right? Here's the problem. Let's say you've been buying ribeye steak every week. It's $15 a pound. Then the price doubles to $30 a pound. Under the old system, the CPI would record that as 100% inflation on steak. But under the new system, the CPI assumes you're rational. You switch to chuck roast at $12 a pound. Your total spending stays roughly flat. Therefore, the official inflation number says there's no real inflation in the meat category. But here's what they're not measuring. You're eating worse food. Your standard of living declined. The CPI is now measuring the efficiency of your poverty management, not the cost of maintaining your quality of life. It's tracking how well you're downgrading, not how expensive life is getting. There's a popular myth online that says the CPI literally swaps steak for chicken to hide inflation. That's not exactly true. The reality is more subtle. The Bureau of Labor Statistics uses something called geometric weighting. It assumes substitution within categories. If premium ice cream doubles in price, it assumes you switch to store brand. If name brand cereal gets too expensive, you buy the generic. Because you switch, your spending at the register might stay flat. So the CPI reports low inflation, but you're eating worse cereal, wearing cheaper shoes, buying lower quality everything. The government has redefined inflation as the measure of your willingness to accept less. But the substitution bias is just the appetizer. The main course is housing. Until 1983, the CPI tracked actual home prices. It factored in what it cost to buy a house, including mortgage interest rates. But this created volatility in the inflation data because of the wild interest rate swings in the late 70s. So the Bureau of Labor Statistics made a switch. They stopped tracking home prices entirely and started tracking something called owner's equivalent rent. This is a survey where they ask current homeowners a hypothetical question. If you were to rent out your house today, how much do you think you could get? It's a guess, a made-up number. Nobody's actually paying it. And this is now 25% of the entire CPI calculation, a fantasy price that nobody pays, representing a quarter of official inflation. Here's why that's devastating. Over the last 2 decades, home prices have exploded because of low interest rates, institutional buying, and limited supply. But owner's equivalent rent, the thing the CPI tracks, rises much more slowly because it's based on rental markets, which are constrained by local incomes. So you get this massive divergence. Let me show you the math. From 1950 to 2000, everyday inflation and home price appreciation moved together. Both went up about 600% from the baseline, lockstep, but then something broke. From 2000 to 2023, while the official cost of living grew by around 60%, the cost of buying a home grew by over 200%. That gap, that massive vertical separation, is the hidden inflation the government explicitly excludes. The CPI became a tool for measuring the cost of surviving as a renter, not the cost of thriving as an owner. And that's the scam. Because your raises, your social security adjustments, everything tied to inflation is based on a number that deliberately ignores the single biggest expense of building wealth. Now, you might be thinking, okay, the measurements are rigged, but can't you just work harder and out-earn the rigged system? Here's where the second trap kicks in. Let me tell you about a guy named David. Not someone I know personally, just a composite of about 1,000 people in this exact situation. David works in tech, mid-level software engineer. He lives in Austin. After grinding for 3 years, he finally gets promoted to senior engineer. Comes with a $20,000 raise. He's making $120,000 now instead of $100,000. Big moment. More responsibility, more stress, more late-night Slack messages, but 20% more money. Except here's the math. That extra $20,000 doesn't land in his account. It falls into his highest marginal tax bracket. Federal income tax takes 24%. Texas has no state income tax, so he's lucky there. But Social Security and Medicare take another 7.65%. So right out of the gate, 32% of that raise disappears. His $20,000 raise becomes a $13,600 net increase, about $1,100 a month. Now, let's adjust for reality. The media keeps saying inflation is cooling to 3% year over year. But David's lived experience is cumulative. Since 2020, food prices are up 28%. His rent is up 35% because Austin became a tech hub. His car insurance doubled because of the EV repair costs in his area, affecting the entire market. His property tax, because he bought a small condo in 2021 at the peak, is up 40%. So David's actual cost of living has increased by something closer to 30% over 3 years. His after-tax raise of 11% is supposed to fight a 30% cumulative increase in expenses. He signed up for more responsibility and more stress, and his purchasing power went backward. He's objectively poorer than he was 3 years ago, despite working harder and getting promoted. This is the hidden tax of inflation. The tax brackets are fossils. In 1980, earning $100,000 made you genuinely rich, the top 1%. So high tax rates made sense. But we don't live there anymore. The dollar has been debased. $100,000 in 1980 had the buying power of about $370,000 today. But the tax code hasn't adjusted proportionally. It still treats a 6-figure salary like your wealthy elite. The IRS loves this. It's incredibly profitable. Tax revenue automatically rises with inflation without Congress having to vote on anything. But it devastates you because your labor is being devalued at 2 points. Once when the money is printed, and again when the money is taxed at brackets designed for a currency that no longer exists. But here's the deeper question. Why is it so hard to get a raise that actually beats inflation? Why have wages stagnated for 50 years while productivity went vertical? The answer is a geopolitical shift in the 1970s that broke the relationship between how hard you work and how much you get paid. There's a story about a factory town in Michigan. 1965, General Motors has a plant there. They make transmissions. The company and the workers are stuck together, geographically bound. If GM wants to make transmissions, they need the factory in Michigan and the workers in Michigan. Neither side can easily leave. This creates a balance of leverage. When the company has a great year and profits go up, the workers have negotiating power. They can demand a share because the company can't just move the factory to Vietnam overnight. The cost of relocating is too high. So from 1948 to 1973, there's this beautiful chart. Productivity and wages move in perfect tandem. When companies figure out how to make 10% more widgets, workers get paid 10% more. It's a symbiotic relationship. But then, around 1973, those lines split. Productivity keeps climbing in a straight line up and to the right. Wages flatline. This is called the Great Decoupling. And the most compelling explanation is the introduction of global labor arbitrage. Technology and trade policy changed the physics of business. Suddenly, capital became mobile. You could move money, blueprints, supply chains, and intellectual property across borders with a shipping container and a wire transfer. But labor remained geographically fixed. The workers in Michigan can't move their families to Bangladesh to compete for their own jobs. And they certainly don't want to work for Bangladesh wages, which would mean accepting a 90% pay cut and a complete collapse in their standard of living. This created a fundamental leverage imbalance. Corporations could now access a global workforce to minimize labor costs while selling products to wealthy Western consumers at premium prices. So when technology made companies more efficient, when productivity doubled, the gains didn't go to the workers. Why would they? The workers are now replaceable in a global market. Instead, the gains accrued to the things that were scarce and optimized: capital, intellectual property, shareholders. This is why companies can post record profits while simultaneously laying off thousands of people. It's not malice. It's not evil executives twirling mustaches. It's the cold logic of a globalized economy. The system is designed to reward the mobile asset, capital, and squeeze the fixed asset, labor. This is the defining economic tension of our era. And here's where it gets even more interesting. What happens when an entire generation looks at this rigged system and realizes they can't win? Let's go back to the carnival metaphor. You're standing there throwing balls at milk bottles, but you've done the math. The back wall is moving away from you at 10 feet per year. Your throwing distance improves by 2 feet per year. You will never close the gap. It is mathematically impossible. So what's the rational response? You stop playing the game. This is what the media calls doom spending, but that label misses the point entirely. Young people aren't being irrational. They're being coldly logical. Here's the math they're doing in their heads. The average young person can save maybe $500 a month if they're extremely disciplined. That's $6,000 a year. Sounds good, right? Except the median home price in a decent city is $500,000. You need $100,000 down for 20% to avoid PMI. At $6,000 a year, that's 16 years of saving just for the down payment. But here's the problem. If that house appreciates at even 7% a year, which is below the historical average, it gains $35,000 in value annually. Your savings of $6,000 per year literally cannot catch up to the appreciation. The asset is running away from you faster than you can save. You're not in a race. You're in a mathematical impossibility. So the rational actor makes a calculation. If the future, represented by home ownership, financial independence, starting a family, is mathematically out of reach, why sacrifice the present for it? That $7 oat milk latte costs $2,000 a year if you buy it daily. Boomers love to point this out. Cut the latte, save for a house. But the young person knows that $2,000 gets them 0.2% closer to a down payment on a house that will rise in price by $35,000 in the same year. The math doesn't work. So the logic flips. That $2,000 spent on daily lattes won't change their life in 10 years, but it improves their daily experience right now. Same calculation for the trip to Europe. $4,000 sounds like a lot, but it's still less than 1 month's rent on the life they'll never be able to afford anyway. at least the trip creates a memory. This is why doom spending isn't irrational. It's economically rational despair. It's the realization that the ladder has been pulled up, so you might as well enjoy the view from the ground floor. And ironically, this behavior keeps GDP humming along nicely. Consumption stays high, corporate profits stay strong, the economic headlines look great, but it hollows out the financial foundation of an entire generation. It marks the transition from a society of owners to a society of renters. I spent 20 plus years running my own business, surrounded by accountants and tax attorneys who showed me how money actually moves at the institutional level. And here's what they taught me. The game isn't rigged in the sense of some conspiracy. It's rigged in the sense that the rules have changed and most people are still playing by the old rules. The old deal was simple. Work hard, save money, buy assets, retire. That worked when a dollar was a store of value, when wages tracked productivity, when housing cost 3 times your annual salary instead of 10 times. But we don't live in that economy anymore. The new economy has 2 tiers. There's the economy of income, where you trade time for money, and there's the economy of assets, where money compounds while you sleep. If you stay in the first economy, you're running on a treadmill that's programmed to speed up faster than you can run. You're fighting the CPI that doesn't measure real costs. You're fighting a tax code designed for a currency that no longer exists. You're fighting global labor arbitrage. The only way to win is to stop playing the game of labor and start playing the game of capital. Let me be very clear about what this means in practice. It doesn't mean you quit your job and become a day trader. It means you understand that cash is a melting ice cube in a fiat currency system. You cannot save your way to wealth when the money printer runs continuously. You have to convert your income into assets as fast and as aggressively as possible. You need to own the things that benefit from money printing rather than being diluted by it. For most people, that means dollar cost averaging into broad market index funds. Not as a nice-to-have retirement supplement, as a survival necessity. The S&P 500 has returned about 10% annually over the long term. Housing has appreciated at about 7%. Meanwhile, cash in a savings account loses 3 to 4% per year to real inflation. The gap between those numbers is the difference between building wealth and getting poorer in slow motion. Here's a real scenario. 2 people, same income, $75,000 a year. Person A follows boomer advice. They save 10% in a high-yield savings account. That's $7,500 a year. After 10 years, with 2% interest, they have about $82,000. Sounds responsible. Person B takes that same $7,500 and puts it into an S&P 500 index fund. After 10 years, assuming the historical 10% return, they have about $130,000. That's a $48,000 difference. Same discipline, same sacrifice, completely different outcome. Now extend that over 30 years, and person A has about $250,000. Person B has over $1.3 million. The difference isn't effort, it's understanding which economy you're playing in. I'm retired now with a few million invested in the market, not because I'm smarter than anyone else, because I learned this lesson early from people who dealt with institutional money. They taught me that the system isn't designed to help you save. It's designed to help you consume. Every incentive is aligned to keep you in the income economy, trading time for money, spending that money on depreciating goods, and staying on the treadmill forever. The way out is to own equity. Own the companies that employ people, not be the person employed. Now, here's the part nobody wants to hear. This doesn't mean everyone will make it. The math says most won't. Because even if you understand the game, you still need enough surplus income to invest. If you're living paycheck to paycheck because rent and food take 90% of your income, you can't play the asset game. You're stuck. And that's the structural trap. The system has narrowed the bridge between the 2 economies. It used to be a wide open highway, now it's a tightrope. And every year, they raise the tightrope a little higher. So what do you actually do with this information? 3 things. First, treat every dollar as a soldier in a war. You're fighting currency debasement. Every dollar you hold in cash is a soldier that's actively weakening. Every dollar you deploy into productive assets is a soldier that's working for you. Your job is to get as many soldiers off the beach and into the fight as fast as possible. That means automating your investments so you don't even see the money hit your checking account. Set it up so a percentage of every paycheck goes straight into index funds before you can spend it. Second, understand that time is the multiplier. A 25-year-old investing $5,000 a year until 65 at 10% ends up with $2.6 million. A 45-year-old starting the same plan ends up with $315,000. Same annual investment. The difference is 20 years of compounding. That gap is a factor of 8. This is why starting early is the only free lunch in finance. You can't out-hustle compound interest, but you can give it more time to work. Third, stop thinking like labor and start thinking like capital. Every financial decision should be filtered through one question. Does this move me closer to owning income-producing assets, or does it keep me dependent on trading time for money? That doesn't mean never enjoy anything. It means being ruthlessly honest about the trade-offs. A $60,000 truck is not just $60,000 today. It's the future value of that $60,000 invested over 20 years, which is about $400,000. You're not buying a truck, you're buying a truck instead of half your retirement. Make the choice consciously. The disconnect you feel between the economic headlines and your bank account is real. The structural traps are real, but now you've seen them. The CPI that measures your willingness to downgrade, the tax brackets designed for a different currency, the global labor market that devalues your time, the asset appreciation that outpaces your savings. These aren't opinions. They're the architecture of the system. And once you see the architecture, you can stop fighting the current and start swimming with it. The era of the saver is over. The era of the investor has begun. Don't work for money. Own the companies that do.